Welcome everyone to Trust the Plan. I'm Nick.
And I'm Jim.
And Jim, I believe this is the Feel Good edition.
That's usually one of the early ones in the season here, yeah.
That's right. So, interesting football weekend, right?
Yes.
Got a Michigan win and a Lions win.
Yeah. Nice bounce back win for them.
Yeah, for both.
For both,
right?
really, yeah.
For Michigan, we predicted we thought the Texas game, the Ohio State game, the Oregon game would be like the big three, and we thought we got to win one of them, right? Well, we weren't really considering USC in that conversation, but we probably should have.
Yeah, they've had a pretty strong season to start, so it was good to see Michigan come out and show up that game.
Yeah, last year they were like 8-5, and so you lose 5 games, you lose some of your mojo, and they came in starting the season maybe like ranked 23rd or something, but they beat LSU right out of the gate and looked pretty strong doing so. So they were number 11 coming into that game, and we handled them, pretty well, I guess. We handled their offense decently.
Yeah.
And our offense did just enough, and our defense with Will Johnson did just enough.
Yep.
So solid win. That still leaves Ohio State and Oregon on the schedule. But I got to say, after that Texas game, I looked at the schedule and I thought, who are we going to win?
Yeah.
Who are we going to beat
Oh,
here?
no.
Like, Illinois is looking great. Indiana is looking great.
Yeah.
Michigan State was looking really good, but not necessarily anymore. So, I feel better, but it's still going to be a grind.
Yeah. Still a few things up in the air, yet to be determined.
Yeah. I'm definitely not calling for the 4th straight Big Ten championship or a back-to-back natty.
Right.
So, Jim, last week we had an exciting week in the markets with the Fed cutting, the FOMC committee cutting rates 0.5%.
Yeah, it was kind of had been anticipated. I think people have been eagerly waiting that for a while. Everybody, the consensus was a 1/4 point rate cut, and it kind of bumped up to a 50 basis point or 0.5 point as we got closer. So I think the market got what it wanted. So yeah, we think that should be a good thing long term.
Yeah, it's interesting how it worked out because everyone was expecting a 1/4 point. Okay, everybody, and it wasn't until the last weekend, when there's a couple articles, one in the Wall Street Journal, one in the Financial Times, where the authors, the journalists said, we're expecting maybe 50 basis points. And then everyone's expectations turned. And this guy, Nick Timmeros from the Wall Street Journal, I'm telling you, he's the pawn.
Yeah.
Okay, he's the Fed's puppet, right?
He gets the scoop.
And not in a bad way, Yeah, he has the scoop.
Yeah.
So when he writes it, that they're signaling to the public that this is what we're going to do. And sure enough.
He had it.
So, okay, so what do we learn? What's going to happen here? Well, first of all, we've got our money markets, our beloved money markets now. The rates are going to be dropping by 50 basis points, right? Here we are. Okay, so that's the first thing we want to think about. We're going to have lower money market returns.
Yeah, and this is something we brought up probably a good month or 2 months ago, where we said once they start cutting rates, those money markets aren't going to be, what they had been. People had kind of been using them as investments, right? Because you could get over 5%, no risk, and it was great. But we knew once rates start cutting rates, the money markets were going to feel the effects.
Yeah, we did, and we said, look, money markets are for your emergency fund or money that that you need in the next year or two. But beyond that, it doesn't make that much sense, even though the rate was good, because we anticipated the rates coming down. And what we argued for was for long, I don't want to say long-term money, but intermediate-term money, holding fixed income, holding bonds. And since summer, summer just ended technically like 2 days ago. But since, probably since we made that argument, fixed income has done really well, maybe like a 4 or 5% total return since then in just a few months.
Yeah, probably in anticipation of the rate cut, it was becoming more and more likely. So, the bonds began to appreciate.
Definitely.
Anticipation, yeah.
Yeah, it's that appreciation we were hoping for, and it's been good. Now let's talk about stocks. So hopefully this is showing up well. If you're listening, please watch on YouTube because you can see Jim's nice haircut and also the charts. So today the chart is, what does the S&P 500 do 12 months after the first rate cut? So last week was the first rate cut. So that's our first measuring moment. And we fast forward 1 year, and this data goes all the way back to 1929. So there's not that many rate cycles, right?
Yeah.
If you think about it, the Fed has been pretty active lately, but rate hikes going back to 1929, I did the math here, and the average return 1 year out was 13%.
Okay.
And it was positive like 85% of the time. But we do see some outliers here, right? When it was down, it was nasty. And it actually is the recency bias. So many of you will remember 2001 and 2007. Now, March of 2000 was the market high, so they waited a while before cutting rates, okay? But the 12-month period was minus 13%. But remember, that period was like a 3-year drawdown from March of 2000 to March of 23, right? March of 2000, the bubble popped. March of 2003, the U.S. invaded Iraq, and that was the catalyst for the market turn. And so that was a 3-year drawdown of about 50%. So this 13% did not tell the whole story. And there was a recession, there's a bubble, there's 9/11.
Yeah, and that's what stood out to me when you see those couple of years that were down. Is I feel like things were different, right? We weren't cutting because inflation had gotten out of control or anything like that. It was some major economic situations that were taking place that the Fed was trying to prop up the market and try to help businesses make business a little easier for them.
The next down period was September of 2007. So most of us think of 2008, right, as the big crash, which it was. But the Fed did start cutting in September of 2007. And if you recall, Bernanke and the team, right, they were seeing some rumblings with with Bear Stearns and what do they call the low rate mortgages, not low rate, yeah, the subprime mortgages, right? So there's a little bit of cracks that started showing up then. And again, it didn't tell the whole story, this minus 17%, because again, it was like, a multi-year drop and it went down 59% peak to trough. And it took like 5 years to recover. So this chart does not do that period of time justice. But look, it is an outlier as well. There's 2 of these outliers. Unfortunately, it's the recency bias. And then we have the most recent one, July 19. So the Fed has started raising in 2018, and in 2018, there's basically a zero return for that calendar year. And then in 19, they stopped hiking and started cutting. It was a really quick, kind of like a mini series of hikes and cuts. And then, of course, the Fed could not have known this, but in February, March of 2020, we had the pandemic, and so they took them straight to zero. Right. But anyway, I think this is really interesting to look at the S&P 12-month returns because all of the rest of the time periods were excellent.
Yeah, I think 2 things. One, I think it's great that they're showing this 1 year after, so we don't jump to conclusions like, hey, the Fed cut, the market should rally today, right? It doesn't necessarily mean that sometimes there's, the market has to adjust. So I think it's helpful to see it 1 year out. But the other thing is, the rest of it shows what we would expect, right? Cutting rates makes business easier, makes the economy easier, right? It loosens things up. So we would expect to see a good market, stock market, good bond market, help in the economy. How many people haven't moved because their mortgage rates are so low, right? And they don't want to move into a higher rate. Well, now this should eventually mean that mortgage rates start to ease and so on.
And I don't want to be a negative Nancy here, but the one thing that's, it's not all about the Fed. The Fed is very important and interest rates are very important. But, the narrative will change over the next year. It won't be 100% about the Fed. And one thing that I don't want to be a negative Nancy here, but one thing that we are fighting is that the stocks are overpriced relative to history. So the trailing PE ratio is 23, and historically that's more like 19. So we're starting this period already inflated a little bit, but 23 and 24 we've had really good results. So maybe we were pulling forward those returns a little bit, but like Vanguard and JP Morgan, they're out there saying the next 10-year returns due to these inflated PEs might be like 5%.
Well, just to add to that, there's a guy that we like to listen to, Ryan Dietrich. He's a market strategist. He had done some research for us. It says the Fed has cut rates with stocks near all-time highs 20 times. The S&P 500 was higher a year later, all 20 times. So it's not necessarily, like you said, it's something to be aware of. Doesn't necessarily mean that we're doomed, because there's plenty of history that shows that the S&P can still be up a year higher on a rate cut, even after even being near all-time highs.
Yeah, that's a great post right there. And so we talked about bonds a little bit. The headwinds for bonds are gone, right? Now it's more of a tailwind. With real estate, real estate took a really bad beating. The traded real estate stocks, they went down like 40% in this recent cycle, and so they look like they might be bottoming. This is not a recommendation, but it makes sense if rates are going down, that real estate with mortgages and commercial loans, they could have that headwind going away. Same with commodities, because the dollar. So when rates go down, usually the dollar goes down as well, because less foreigners want to hold the dollar because they're getting paid less to hold it. So if the dollar goes down, then commodities can go up. So gold has been rallying, silver has been rallying, and others as well. So all of these assets, there are bullish stories out there, despite some headwinds we talked about, starting from an overvalued on a historical level.
For sure. Yeah.
Okay. Anything else you want to add on this topic?
I think we covered the main points. I think there's reasons to be optimistic, but always worth having some cautious optimism in there because of the market being higher, at a high point or at this point in time.
Excellent. Well, if you are enjoying this content, please share with your friends. Please click that bell so you get notified. And if you haven't subscribed, please do so. And if you're looking for a second opinion on what you're doing with your financial planning and your investments, please reach out to us at peakwm.com.